Creating lasting wealth is difficult when half of your income goes to taxes every year. It feels like you're always fighting to keep your money. With a low income, you struggle to earn more, and when you finally succeed, taxes make it hard to keep what you've earned. It's a constant challenge, but there is a way to manage both. You can create wealth and decrease your taxes at the same time. The ultra-wealthy know this trick and often pay very little in taxes. Still, you don't need to be ultra-wealthy to achieve this. It's important to know about tax-deductible investments, which help lower your taxes. This episode focuses on that topic. I will share the 7 best tax-deductible investments you can make to cut your taxes while growing your wealth. My name is Jared, and I coach people on the best ways to handle bookkeeping and taxes every day at All Bookkeeping and Taxes. I've helped individuals cut their taxes by over 6 figures simply by reallocating their funds. You'll learn about some of these investment options in this video. Make sure to save it. If you have questions, feel free to comment below and subscribe for more advice on minimizing stress and taxes. So as we talk about this, keep in mind that your tax amount is based on your income. When you invest in tax-deductible things, you reduce the income on your tax return. This leads to a lower tax bill. Tax deductions are there to encourage certain investments, and all you need to do is learn which ones are eligible. First, we will look at various investment accounts that allow you to transfer money and gain a tax deduction. Next, we will dive into specific assets you can invest in to achieve substantial tax deductions, which we will cover in more detail later in this video. Number 1, traditional IRA. The first item is the traditional IRA, or individual retirement account. Anyone can establish this at firms like Fidelity, Vanguard, or TD Ameritrade. It's not necessary to go through your job or business to set it up. Here's how it operates. A traditional IRA allows you to contribute about $7,000. When you do this, you can receive a tax deduction. This is for each individual. If you have a spouse, you can contribute another $7,000 for them. You can also create accounts for your kids, adding $7,000 for each child. If your tax rate is 40%, you will save 40% on your contributions to the IRA. In a tax-deferred account, you can invest in assets like stocks, bonds, and CDs to increase your wealth until retirement. You won't pay taxes on the growth of these investments. Taxes are only applied when you take money out, which you can begin doing once you reach around 59.5 years old. When you are in a high tax bracket now and plan to be in a lower one during retirement, this account can help you save on taxes. Number 2, traditional 401k. Moving on to the traditional 401k. It is similar to an IRA but is provided by a company and has higher limits for contributions. This means you can enjoy larger tax deductions and pay less in taxes. You have the option to participate in a 401k plan from your employer, or you can create one through your business or side hustle for even greater tax perks. Here's how a traditional 401k functions. As an employee, you can contribute about $23,000 of your salary to a traditional 401k account. By doing this, you can generate a tax deduction of $23,000. If you are self-employed, you can also contribute from your business, which can be as much as $69,000. This means a tax write-off of $69,000, nearly 10 times the limit for a traditional IRA. Remember, you can benefit from both a traditional IRA and a 401k at the same time. If you fully utilize both accounts, you can achieve a tax deduction of $77,000. Remember, you can do the same for your spouse, doubling that amount to $154,000 in a single tax year. This is money that won't be taxed, allowing you to invest it and grow your wealth more quickly than if you used after-tax dollars. There are guidelines for how these contributions operate, and I created another video to cover this topic. Don't forget to subscribe for more information. Number 3, health savings accounts, HSA. With these accounts, you get a tax deduction for your contributions. Unlike retirement accounts, you can spend the money in this account on health costs you already have. Much like gym memberships, massages, chiropractic services, and doctor visits, here's how it functions. You can contribute between $4,000 and $8,000 to an HSA depending on your filing status. When you do this, three things take place. 1. You earn a tax deduction for the amount you contribute to your HSA. 2. You can put your HSA money into things like stocks or bonds. 3. You can use your HSA funds for approved health costs. If you pay for those expenses with your HSA, you will get a tax deduction. Number 4, donor-advised funds. If you donate to charities, you can increase your tax deductions by contributing to a donor-advised fund. A donor-advised fund is similar to a savings account for your future charitable donations. You can easily create one at Fidelity. Here's how it works. When you donate money to a charity, you get a tax deduction in the year the charity receives your gift. Moving money to a donor-advised fund gives you an instant tax deduction for your contribution, not when the charity gets it. Number 5, small business tax deductions. Running a small business is one of the quickest ways to increase your wealth and also a smart way to cut down on taxes. Business owners can deduct expenses before paying taxes, while most individuals pay taxes first and then handle their expenses with the remaining money. When business owners deduct their expenses first, they can report a smaller income. This leads to lower taxes. The tax rules allow them to write off many things if they are for business, such as mortgage or rent, utilities, vehicles, food, health expenses, travel. Number 6, real estate investments. Real estate is considered one of the best ways to save on taxes. By purchasing an investment property, you are essentially running a business, which lets you deduct most of your costs. Plus, you can also deduct depreciation, a non-cash expense that doesn't take money from your wallet. This deduction often eliminates most of the rental income shown on a tax return, leading to little or no taxes on that income. Number 7. Oil and gas investments. This option offers significant tax benefits that often go unnoticed. When you invest in an oil and gas company, you can deduct 65 to 85% of your investment in the first year. Oil and gas investments offer two major tax advantages. 1. Like real estate, these companies can claim significant depreciation, leading to a large tax deduction. 2. This deduction can help reduce other income on your tax return. Final thoughts. Make sure to subscribe to our channel for more ideas on how to cut your taxes. If you want a tax plan that promises to save you a lot of money, head over to All Bookkeeping and Taxes Now to connect with a tax professional quickly.